All right. Hello and welcome back to Principles of Accounting 1. Still happy to have all of you with us. You made it through the spring break, and hopefully you all enjoyed some much needed time to reset, relax, and take it easy after all those midterm exams, I'm sure. Appreciate all of you being here today as we talk about accounting for receivables. So I wanted to quickly show you where we are in the classroom. We are sitting in week 9 of our class together. So we're more than halfway through, and I can promise you the next few weeks will go by pretty quickly. So I'd like you to try your absolute best to make sure that from this point forward, we are doing our best to make sure that all of our work is completed and submitted on time. Um, as you know, it's almost impossible to pass this course if you don't do all of the work. And I'm so glad to see a lot of you uh, were able to catch up on your missed work just before that midterm exam. So I really do appreciate that, and I just want to let you know that. Um, and again, you're also more than welcome to work ahead of time if you like as well. Everything in this course is available, unlocked, and ready for you to give it a try. Okay, so if you want to work ahead, you're one of those people that wants to knock it out early, you're more than welcome to do so. So, but again, I appreciate all of you. I appreciate your hard work in the course so far, and I'm looking forward to finishing this second half of the semester off strong. So, thank you all so much. Okay, let's jump into our week 9 conversation on accounting for receivables. Now, the first question I have for you is, what's a receivable? What is a receivable? Who can answer that question for me? What is a receivable for the business? What does it mean to have a receivable?
Isn't that, money that's owed to you, owed to the
Yeah,
company?
yeah, exactly. Yeah, you're right, Sam. So it's money that's owed to us. It's money that's owed to the company. That is a receivable. And the way that we established that receivable is we sold a good or a service to a customer and delivered that good or service, right? So that's earned revenue. We earned the revenue, but the customer has not yet paid us for that sale of the good or the service. So that's what creates what we call a receivable. Very well done. And you'll notice that there's more than one type of receivable out there. We have accounts receivable. That's where we made the sale to the customer hasn't paid us yet. We also have what we call a note receivable. A note receivable is kind of like a loan that the company gave to a customer. We converted their account receivable into a loan, a note receivable, because maybe they got behind, they hadn't paid us for a while, and we said, hey, you know what, we'll convert that to a loan. You'll pay us what you owe us plus some interest, right? We call that a note receivable. And those are different types of receivables, and we'll talk more about that. Yes, very good. So we're going to talk about that concept of converting an account receivable to a note receivable. We're also going to talk about what happens if we don't get paid, right? What if the customer falls off the face of the planet? We can't get in touch with them. The number they gave us is bad. The email they gave us is not right. Uh, you know, what happens if they don't pay, right? We have to write it off, and there's two ways to do that, and I'm going to show you what that looks like. Uh, and then what happens if they don't pay and then they come back later and pay us? I'm going to show you what that looks like as well. There's a lot of interesting things that happens with receivables. So as Sam had accurately mentioned, a receivable is any time that somebody owes the company money for whatever reason. That's an account receivable. Yeah. We made a sale on account, right? And the customer has not yet paid us. So that generates what we call an account receivable. Now, interesting thing, uh, as you know, some customers pay in cash over the counter, and some customers will pay us later on accounts receivable. It's important for you to track that difference. Okay, what percentage of your sales accounts for account receivable and what percentage is cash? Now, the reason why that's important is because you want to have a good understanding of your business and when you expect to collect cash in the future from your accounts receivable. Now, on this chart that you see here, we got four companies that are pretty well known and the percentage of their sales that are in accounts receivable. And you'll notice that some of them are pretty low, some of them are pretty high. Uh, Now, you might be asking, well, where's a good place to be? Well, you typically want to have some type of account receivable if you're selling on credit terms. Uh, but you don't necessarily want that percentage to be too high. And you also don't want it to be too low, right? If it's low, that means you're that one of two things. The majority of your customers are not on accounts receivable, but also also could mean that you're doing a really good job of turning it, right? Of collecting that cash from your account receivable. So there's a couple of things to look at there. But it's really important to make sure that we're tracking every dollar amount that each of our customers owes us individually, right? We call that the subsidiary ledger. The subsidiary ledger of accounts receivable shows us a list of all of our customers that owe us money. It shows us the dollar amount and the customer's name. Okay? Uh, and of course, as they pay, that balance goes down for that customer. Or as we sell them more on receivables, that balance is going to go up for that customer. So that's the best way to think about accounts receivable in general sense. So here in Principles Accounting 1, we call it financial accounting because we make journal entries like this, right? Uh, Here we have an example of a sale that the company made on account, meaning on accounts receivable. And we also have an example of the company receiving payment from another customer, a different customer. And these transactions both happened on July 1st. So let's take a look. Our company had a credit sale of $950 to Comp Store, and we collected $720 from RDA Electronics from a prior sale. And these both happened on July 1. So you see that first transaction, we made a sale on account. So we debit accounts receivable, and you'll notice that when we debit that account receivable, you'll notice that dash comp store, that's the customer's name. So it's really important that you designate the sale to the right customer. We don't want to upset our other customers or have inaccurate balances for their accounts. So we debit account receivable for that specific customer, and then we credit sales. Okay? The second transaction, we're receiving payment from a prior sale for a different customer. So we debit cash, in this example 720, and we credit account receivable, RDA Electronics, that's the other customer's name, 720. Now, what does it look like on our ledger accounts, on the general ledger? So here we have on the general ledger for accounts receivable, we sold 950, we received 720, and you see how it updates that balance. If I double click or zoom in on that balance, I can see from the day's transactions, what's happening, right? And I can further break down in the subsidiary ledgers which is the ledger for each customer, what their total balance is. So here we have, for example, RDA Electronics. We had prior sales of $1,000 on June 30. On July 1, they paid 720. That reduces their total balance down to 280 is what they owe us remaining. For the comp store, they had a prior balance of 2,000. They purchased another $950 from us on account. That increased their balance to 2,950. Now, of course, later on, when they go to pay us, we're going to reduce their balance, you see. And this just kind of shows you how those subsidiary ledgers work. And, the good news is because of modern technology, we have software, like QuickBooks or Sage or FreshBooks or, whatever you're using for your accounting software. It tracks all that for us, right? You just have to be careful of, what customer you're signing that receivable to. Okay. Now, here's another thing that sounds like receivable, kind of, sort of. Credit cards. When you think of a credit card transaction, we treat it the same way as cash. Okay? The business treats a credit card the same way as cash. The customer obviously doesn't, but the business does. So the way it works is, let's say you purchase something from the store for $100 and you use your credit card to pay for it. Okay? This is what happens on the business side of that transaction. The business debits cash for $96. Why? Because in business, if you accept credit cards as a form of payment, the business has to pay what's called a credit card transaction fee. And that fee is for the processing of that credit card, you see? So for every time the credit card gets swiped through the machine or tapped or whatever, the business has to pay a fee. And that fee is a percentage of the total sale. And that percentage of the total sale gets remitted to Visa, MasterCard, or American Express, or whoever it is. Okay? The same thing applies to debit cards. Okay? So if the business accepts debit cards or credit cards, there's a processing fee that the business has to pay, and it's usually a percentage of sales from cards. Okay? So in this example, the fee is 4%, which is probably close to accurate. I think American Express, is like 6% or 7%. Visa and MasterCard, I think they're around 4 or 5% right about now. Okay, so in this example, we made a sale of $100. The customer's paying us with a credit card. We debit cash $96. We debit credit card expense $4. Okay, because it's a 4% fee on a $100 sale. And then we credit sales $100. So you might be wondering, where does this credit card expense go? It goes on your income statement. It's an expense. You see? Okay, so that's credit cards. Now, what happens when a customer don't pay us? Oh my goodness. Sometimes when a customer don't pay me, I feel a certain kind of way. I get a little upset. Especially if I got to track them down. You know what I mean? Pay them a visit. Like, hey, what happened to, that stuff you owed me, huh? Right? So, couple of things. Let's say you got a customer and they don't pay you within the 30 days, that's on the account receivable. Another 30 days goes by. You didn't hear from them. You sent a second notice. Another 30 days. You send a third notice. Now the demand letters come out. And then, you know, 91 days plus. Oh, they ain't going to pay you. So there's a method for writing that off. And we call this situation a bad debt. A bad debt is an account called bad debt expense. And this account represents the amount that is what we call uncollectible. The customer, we expect in business that not all customers are going to pay us. It's just a fact of life. If you're accepting accounts receivable in your business, you got to expect that not all your customers are going to pay you. You know what I mean? So, because of that, we have what we call bad debt expense. And this is a method for us to allow for bad debt. So, there's two methods for bad debt expensing. The first is called the direct write-off method. This is a very simple method. We just take the amount that the customer did not pay us, we debit bad debt expense, and then we credit that account receivable for that customer. Very simple process. The second method is called the allowance method for bad debt. And in the allowance method, we're going to estimate a percentage of our total account receivable that we expect we're not going to collect. Right? It's an estimate. We might say, 3% of all of my accounts receivable is going to be uncollectible. Right? So we call that the allowance method. And I'm going to show you what both of these look like. So here's the first method for writing off a bad debt. This is the direct write-off method. We record it directly. Okay, that's why I call it direct write-off method. So we got a customer. Here's what happened. I got a customer that I sold $520 worth of stuff to on account receivable. And this customer, 30 days went by and the customer didn't pay. Okay? So I sent a second letter saying, hey, 30 days past due. Where's my money? And another 30 days went by. So I figured, okay, customer's not going to pay us. You know what I mean? It happens from time to time. So I didn't hear anything from this customer. So I said, okay, let's write off the debt. Let's write off that customer's debt. So I debit an account called bad debt expense for the $520 that this customer owed me. And I credit their account receivable $520. I'm reducing their receivable by $520. Because why? Because they're not going to pay me. So the receivables no good. I'm writing it off. That's what this means. Okay? It happens from time to time. So we write it off directly. What this does in practice is that it reduces, because you sold something to a customer and the customer never paid you. So therefore, you didn't really make the sale. You shouldn't be taxed on that sale. So you write it off, right, through bad debt expense. It reduces your total taxable amount. That's the idea behind it. That's why we call it writing off. Okay. Now, let's say, magically, here we are, 3 months later. This same customer wakes up and it's like, I owe Dr. B money. Well, I better pay it. Okay, so thank God. All right, customer woke off, they're paying, right? So customer comes in, hey, Dr. B, sorry, I totally forgot about this. And I'm like, oh, it's been 3 months, but I'm happy that you're paying your bill. So I reinstate, the first thing I do is I reinstate their account receivable. So I debit account receivable 520 and I credit bad debt expense 520. That's what we call a reversing entry, right? We talked about those, I think, a couple weeks ago. Reversing entry, that's that first transaction there. I reinstate the account receivable and back off on the bad debt expense. And then I receive the cash right away. Make sure, right? Debit cash 520, credit account receivable 520. Yeah. So sometimes that happens too, right? That's a good thing when they come back and they pay. So, the good and bad with direct write-off method. Expense recognition requires the expense to be reported in the same period that the sales they help to produce. What does that mean? Quite simply, if you're going to use the direct write-off method and you made a sale in, we'll say 2024, you made a sale to the customer, by the end of 2024, you need to recognize that bad debt expense because it has to happen in the same period in which you made the sale. See what I'm saying? So make sure that it's the matching principle, yeah? And the second thing is that materiality constraint permits direct write-off method if it results in approximate results using the allowance method. Quite simply put, it's a low-cost direct write-off method that adheres to generally accepted accounting principles, and it could be used. But here's the thing: with direct write-off method, we don't estimate. Okay, if you're going to estimate a percentage that's not going to be collectible, then we're going to use what we call the allowance method. I'm going to talk about that next. So the allowance method, as I had mentioned, it is an estimate. We are allowing for bad debt expense to happen. Okay, we're saying, hey, you know what? There's a certain percentage of all of my credit sales, my accounts receivable, that I'm not going to be able to collect. Right? It's just part of business. I fully expect that, 3% of all of my credit sales, meaning accounts receivable, I'm not going to be able to collect them for whatever reason. Okay. So I estimate for it. There's two advantages to doing this. One, of course, is I can record that estimated bad debt expense related to when the sales are recorded. I could do it monthly or I could do it annually as long as I adhere to the matching principle, right? It has to be within that year. And two, it reports accounts receivable on the balance sheet as an estimated amount of cash to be collected. It's good for budgeting. Okay, so what does it look like? Here's a nice example of this. So here I have my company. We made credit sales of $300,000 during our first year. And at the end of the first year, 20,000 remained uncollected. So based on similar experience, we estimated that $1,500 of accounts receivable will be uncollectible, meaning the customer is just never going to pay us. Okay, it happens, right? You know, customer something happens to the customer, or the customer disappears, or they give us bad information, or whatever, right? They just don't pay us. So we allow for it. In this example, 1,500 bucks. So what we do is we debit bad debt expense and you'll notice the date at the end of the year. Yeah, because we have to apply the estimate within the same accounting period, meaning the same year. So we debit bad debt expense 1,500, and we credit the allowance for doubtful accounts 1,500. Now check this out. Allowance for doubtful accounts. This is what we call a contra asset account. This is not on the income statement. This is not an expense account. Bad debt expense, that's the expense account. The asset account is allowance for doubtful accounts. At the beginning of the course, you probably recall me saying that the normal balance for all asset accounts is a debit, right? You remember that. This is one of those rare, very rare asset accounts because the allowance for doubtful accounts is called a contra asset account, just like accumulated depreciation is. What this means is it normally holds a credit balance. It's contra, in contrast, to the accounts receivable. Okay? So, in our example, bad debt expense 1,500, and we credit allowance for doubtful accounts 1,500. You'll notice here at the bottom, my T accounts, also known as my ledger accounts. For account receivable, my balance is 20,000. For allowance for doubtful accounts, my balance is 1,500. Okay? On the next slide, I'm going to show you, what this looks like. On the balance sheet, you'll have your account receivable balance is going to show 20,000. But then you're going to have this separate account called the allowance for doubtful accounts, and that's going to have a credit balance of 1,500. It's in contrast to accounts receivable. Okay, that's why we see the balance, or the actual balance, accounts receivable net of allowance for doubtful accounts, 18,500. You see how that works, right? Okay. Let's go through an example using the allowance method of writing off a bad debt. Okay, back to our customer. This guy. Our company determined that our customer of has a balance of $520 in their accounts receivable, and they're not going to pay us. So we're going to write that off using the allowance for doubtful accounts method. So we're going to debit allowance for doubtful accounts 520, and we're going to credit the account receivable by 520. Now you'll notice there at the bottom what it does to the ledger accounts. I reduced my account receivable by 520, and I decreased my allowance for doubtful accounts by 520. I'm writing it off. Okay, this is what it looks like before the write-off and after the write-off. Before the write-off, my realizable accounts receivable was 18,500. You see I had the account receivable was 20,000 and my allowance is 1,500. After the write-off, the net realizable value is the same. Why? Because I reduced my account receivable when I wrote off that customer's account receivable, and I also reduced the allowance for doubtful accounts by that same amount because I'm writing it off. Yeah, customer not paying us. That's what it means. Now let's say magically the customer returns 3 months later and is going to pay us just like before. How does that work? Okay, we have to restore their account receivable, and so that means we have to do a reversing entering, right? We debit account receivable for the customer, and we credit the allowance for doubtful accounts by the 520. And then, of course, we're receiving the cash from the customer, so we debit cash 520, and then we credit their account receivable by 520. So just like before, only, of course, the difference here is that instead of the bad debt expense direct write-off method, this is the allowance for doubtful accounts method. Okay, the great thing with allowance for doubtful accounts is I'm estimating, right? I'm estimating either based off a percentage of sales, or I can estimate based off of my balance sheet or my aging report. I'm going to show you what these look like. So, estimating your bad debt expense using the allowance for doubtful accounts method. First is the percentage of sales. It's a very simple calculation. Okay. Uh, and this percentage is usually based off of historical data, right? I looked at my last year or two to determine how many customers didn't pay us by looking at the ending balance of accounts receivable at the end of the year. And I figure, I'll apply a percentage that's just not going to pay us. It's usually pretty low percentage, 1%, 2%, 3%. That's typical. The other method for estimating bad debt expense is what we call using the balance sheet based off of percentage of account receivable and the aging of accounts receivable. And I'm going to show you what all of this looks like. First, the percentage method, very straightforward. Very, very straightforward. Percentage method, we take current period sales dollar amount, okay, how much sales I made for the year, and I multiply that by a bad debt percentage. This bad debt percentage, as I had mentioned, is assigned based off of historical data for the company, and we determine what percentage of customers are not going to pay us back. We call that bad debt percentage. So you take your total sales for the year times the bad debt percentage to equal your bad debt estimated amount. And I'm going to give you an example, of course. So here we have a company that has a total amount of credit sales, that's account receivable, $400,000 in 2021. The company estimated that 0.6% of those credit sales will not be collected, meaning the customer's hard to get hold of, they're just not going to pay us. So let's use that example. $400,000, sorry about the extra comma there, times 0.6%. Okay, which would be 0.006. No, I'm sorry, 0.006 to get us to 2,400. So we make a adjusting entry, technically. Well, yeah, you could call it that. At the end of the period, end of the year, we debit bad debt expense 2,400, and we credit the allowance for doubtful accounts 2,400. Okay. Now that's the example for the percent of sales method. Now, the other method is what we call the percent of receivables method. This is also known as the balance sheet method. It assumes that a percent of the company's receivables are going to be uncollectible. The percentage, of course, is based on company trends, looking at historical data, about a year's worth of data. And to calculate this, we're going to take the total account receivable at the end of the year, and we'll multiply that by the bad debt percentage. And it's that same bad debt percentage that we used before. So it's going to be calculated by taking the total estimated bad debt minus the previous balance in the allowance for doubtful accounts. That will equal the bad debt expense. Don't worry, I'll run through a very similar example. Our company has $50,000 in accounts receivable and a $200 credit balance. 200? Yeah. $200 credit balance in allowance for doubtful accounts. 5% of the company's receivables are uncollectible. Okay? So, first thing we do is we got to figure out what's that amount. So we take the $50,000 in account receivable times 5%. That gives us 2,500. So 2,500, but it's not 2,500, right? Because we need to add the $200 balance from the allowance for doubtful accounts. So the adjustment amount is 2,300. You see? So we debit bad debt expense 2,300, and we credit allowance for doubtful accounts 2,300. So that's the percent of receivables method. Now I'm going to show you what we call the aging of accounts receivable method. The aging of accounts receivable method is another balance sheet method. We use both the past and current accounts receivable information to estimate the allowance for doubtful accounts. Each account receivable is classified based off of its past due date. So what we're doing here is we're estimating the uncollectible amounts based off of how long they've been past due. You see? Because the longer that they're past due, the more likely it is we're not going to be able to collect it. That makes sense, right? Like, for example, if it's current, meaning it's not late, there's a great chance we're going to be able to collect that account receivable. But if it's 1 to 30 days past due, there's a small chance we're not going to be able to collect it. If it's 31 to 60 days past due, okay, there's a better chance that we're not going to be able to collect it. If it's 61 to 90 days past due, there's a really good chance they're not going to pay that bill. If it's 91 days or more past due, there's a great chance we're not going to be able to collect it. You see? So the older it is, the less likely it is that we're going to be able to collect. So the way aging receivables method works is we classify it based off how long it's past due. It's usually current, which is 0 to whatever the current, meaning it's not late. 1 to 30 days late, 31 to 60 days late, 61 to 90 days late, 91 plus. That's how we classify it, and we put it in one of those categories. Each age group is then multiplied by its estimated bad debt percentage. The total is multiplied by that percentage. And then, of course, we add them all up at the end. I'm going to show you what this looks like. So here we have the example from our company. We have all of our customers and their totals lined up, as you can see there on the left. Not due yet means it's current. Okay, so remember we have $50,000 total account receivable at the end of the year. 37,000 of that means it's current. There's a great chance all of them will pay, except for maybe 2% of those customers. So we take the 37,000 minus the 2% to get us $740 during that period that I'm not going to be able to collect. Now you'll notice 1 to 30 days past due. The total amount of customers that are 1 to 30 days past due with us is $6,500. I multiply that by 5% because that's the percent I expect not to be able to collect. That gives me estimated uncollectible for 1 to 30 of $325. I apply that same method for each category. 31 to 60, the total was $3,700. That's the amount that's past due, 31 to 60 days. 10% of that, not going to be able to collect. That's $370. 61 to 90, I got $1,900 sitting out there. That customer hasn't seen me in 3 months. 25% chance I'm not going to be able to collect that. So that's $725. I'm sorry, $475. And then 91 days plus, there's $900 sitting out there already. 40% chance that I'm not going to be able to collect that. That's $360. I add up all of those categories, aging periods, to get a total of $2,270. I'm estimating that I'm not going to be able to collect. See how that works? This is a very common report that you can run in your accounting software, whether it be QuickBooks or whatever it is that you're using. It's called an aging report. And all it does is it tells us how old each of our collectibles are. Taim, go ahead. Go ahead, Taim.
Is the 2%, 5%, 10%, 25, and 40 always the same?
No. These are what the company is estimating.
Okay.
So your company, you might do something else, right?
Okay.
You might say, hey, you know what? I haven't, and you base it based off of your history.
Yeah.
So if you got customers that they haven't, after 30 days, they're just gone, right? Your percentage might be higher. It all depends based off of the company's history. That's
Okay.
where those percentages come from. That's a great question.
Thank you for the clarity.
Yeah, absolutely. My pleasure. So we let me go back. 2,270 is the total amount that we're estimating that we're not going to be able to collect. Okay, so we come here and we have $200 from our prior balance in our allowance for doubtful accounts. Remember, so we need to subtract that out. So that brings us to an adjusted balance of 2070. So we debit bad debt expense 2070, credit allowance for doubtful accounts 2070. That's our total amount that we expect not to be able to collect. That's it if we had a credit balance, meaning we had a balance remaining in the allowance for doubtful accounts before this year. And if we didn't have that balance of $200, there's no need to make the adjustment, okay? Or in this case, we had a balance of $500, we added to it. Uh, so let's take a look at the summary of the two methods. So the first method, as I explained, is the direct write-off method. The direct write-off method is the simplest to use, and that's where we take the actual amount that the customer owes us that they did not pay us, and we debit bad debt expense and we credit their account receivable. That's called the direct write-off method. And then, of course, we have the two methods for estimating bad debt expense. The first way to do this is to find our bad debt expense by a percentage of sales. We take a percentage of sales times our bad debt expense percentage. That equals our bad debt expense. The other method, as I showed you, is percent of receivables or the aging of receivables. Percent of receivables, we take our total accounts receivable balance times the bad debt expense percentage. That gives us the allowance for doubtful accounts. And then, of course, the aging receivables, which was that one that I just showed you, we take the dollar amount by the age of what's outstanding, 1 to 30, 31 to 60, 61 to 90, 91 plus, times that percentage based off of each age. That gives us the total allowance for doubtful accounts when we add them all up. So that just shows you a comparison of the different methods. Okay, so we talked about accounts receivable at length. So now you know exactly what to do if a customer doesn't pay you. How do I proceed? That's how you got to select one of those methods, right? Because otherwise, the reality is if you don't do those things, you're going to be paying income tax on something you shouldn't be paying income tax on. That's why we write it off. Yep. Okay. Now I want to talk about notes receivable. As I had mentioned, a note receivable is when we've converted an account receivable into a loan. Here's what I mean by this. Sometimes you're going to have a customer that's not going to pay you for a while, okay? It happens. Like that one customer that we had, didn't pay us for 60 days, 90 days. So we call that customer up, we get a hold of them and say, hey, you know what? We're going to convert your account receivable into a note receivable. What we're doing in this case is we're saying, not only do you owe us the balance of your account receivable, but now you will also owe us interest. That's what a note receivable is. Okay. The customer in this case, has to sign what we call a promissory note. Now, if you've ever taken out a loan of any sort, for example, maybe a student loan, you had to sign what's called a promissory note. A promissory note is simply put a promise to pay. You're promising to pay this amount of money with interest, either on demand, meaning the bank came to you and said, you got to pay now, or at a stated future date when it's due. Okay? So here's an example of it. We've got the dollar amount, the date, the promissory note was made, when it's due, 90 days after the due date, or after today's date, 90 days after today's date. Promise to pay, who it's being paid to, the dollar amount. Oh, and not to mention the interest rate. You see? So that's an example of a promissory note. Now, we have to figure out when the loan is due, when the promissory note is due. When is the the note receivable due? Right? When does it mature, is what we say. A maturity date is when it is to be repaid. Principal plus interest. When's it due? Call it the maturity date. Here we have an example. This example shows us how to calculate when it's due. All right? What day is it due on? Well, we know it's a 90-day loan. So it's due within 90 days. But when is that? Well, the signature date on the promissory note is July 10th. So July 10th, $1,000, 90 days, 12%. So I got to figure out the maturity date. Well, there's 31 days in July. But I signed it on July 10th, so I subtract 10 days. That means there's 21 days in July. There's 31 days in August, I know that. And there's 30 days in September. So 30 plus 31 plus 21. Well, that's not quite 90. So that means it's due on October 8th. You see how we did that? So this tells us that the loan's due on October 8th. Now, what about interest? The interest compounds. You've heard this before. But to keep things simple, I'm going to show you how to compute the interest rate. We take the principal balance. The principal is what we call the face value. In this case, it's $1,000. Times the annual interest rate, 12%. Times time. Time is the number of days, right? It's a 90-day loan. So we take 90 divided by 360. Now you're saying, Dr. B, there's 365 days in a year, not 360. I know that. The reason why we use 360 days instead of 365 days is because of what we call the banker's rule. There are 360 banking days in a year. There's 5 bank holidays. Yeah, that's why we use 360 instead of 365. So we take $1,000 times 0.12. That's the decimal expression of 12%. Times 0.25. 0.25 is 90 divided by 360. You multiply all those together to get $30 is the interest amount. So how do we record a note receivable? Well, we do this to keep things simple, and we do this based off of the customer, right? So we record a couple things: the date of the promissory note and the face value. That's the first thing that we do. That's the first journal entry that we make. So we make this following transaction. We debit note receivable, $1,000, and credit sales, $1,000. In this case, the customer purchased something from the store on a note receivable, meaning they're paying us the principal plus interest. Okay, that's what that means. And in this example, our customer, it's $1,000, 90 days at 12%. So we sold the goods to her, $1,000 worth for a 90-day loan at 12%. Yeah, so that's the way we record that sale through a note receivable. And of course, we'll record interest as we receive. Here we have an example. This is another example. Sometimes the business might accept a note receivable from an account receivable customer to allow for that past due, right? This is what I was telling you about. Sometimes the customer, doesn't pay us for a while, so we have to figure out a way to encourage them to pay us, and the way to do that is to convert their account receivable into a note receivable. So this is an example of this. Let's assume that our company agreed to accept $232 in cash along with a $600 60-day 15% note. Okay. So customer gives us cash. So debit cash, $232. Debit a note receivable, $600. And we credit the customer's account receivable, right, to reduce the account receivable by that much. Okay, along those lines of the customer not paying us on time, if the customer pays us at the end of that 60 days, okay, take a look at this. The end of the 60 days, October 5th is when I made the agreement with that customer. 60 days from October 5th, that customer needs to pay me the amount, right? The 600 plus interest. So let's say the customer does it. We call that honoring. If the customer doesn't pay us by that date, that's dishonoring. When you honor a note, that means that you're satisfying that note on time, right? You paid the loan on time. You're honoring it. If you dishonor the note, that means you did not pay it on time. And that usually results in other consequences. So here we go. 60 days later, on December 4th, our customer is paying us on time. So they're honoring the note. I debit cashed $615. Why $615? Because of interest, right? $600 times the 15%, or 0.15, times 60 over 360. You see? It equals $15. So we debit cash, $615. We credit note receivable, $600. And we credit interest revenue, by $15. We earn $15 of interest. So, okay, great. That's nice when that happens. But what if they dishonor the note? If the customer dishonors the note, which means they ain't going to pay the loan on time, then what we typically do is we convert that note back into account receivable. Okay? Typically. Some companies might change the interest rate. I mean, that's a possibility as well, right? So, uh, here's what happens. Well, we got our customer, they didn't pay us on time, so they dishonored it. So we're going to convert their stuff back into account receivable. We debit account receivable $615. We're taking that interest that they owed us and adding that to their account receivable. And we're going to credit the note receivable 600 because we're converting it back into account receivable. Now, it happens, It's all part of business. At the end of the accounting period, we always need to make sure that we adjust for our interest. So when we are earning interest, meaning the customer's paying their note receivable, we've at that point earned the interest. It goes from interest receivable to interest revenue. You see, it's earned. So here we have our customer. They accepted a $3,000 60-day 12% note. That was converted from account receivable to a note receivable. At the end of the period, the customer is paying us $15 in interest. So you'll notice the date. This is where that $15 comes from. December 16th. That's 15 days before the end of the year. My company operates on the calendar year. I need to account for all the interest from the year, right? For the matching principal. So 15 days worth of interest here. I take the face value, 3,000, times the interest rate, 12%, 0.12, times time passed. This is 15 days over 360. It equals $15. So end of the year, debit interest receivable, 15, credit interest revenue, 15. Now, of course, at the end of the 60 days, which is on February 14th, I need to account for the rest of that interest. So I've already accounted for the 15 days of it. That's what you see in interest receivable. Now, what about the rest? We take the face value times the interest rate, 0.12, times the remaining 60 days over 360, gets us to $60. I'm sorry, the total would have been 60, but they already paid us we've already accounted for 15. That gives us a difference of 45. You see? So we debit cash, 3,060, credit interest revenue, 45, credit interest receivable, 15, because we're converting that to interest revenue, or we already did at the end of the prior year. And we credit the note receivable of 3,000. Now, sometimes, if you're lucky, a customer might pay you before the note receivable matures. Right? That happens sometimes. Customer pay you before it's due. So I'm going to show you how to account for that. I'll also show you, on the other side as well. So here we go. Companies can convert their receivables to cash before they're due if we need the cash, or don't want to be involved in collection activities. That's typically why the companies do this. Okay, so here's how it works. A company can sell its receivables to a finance company or a bank. We call that factoring. Okay. You may wonder if, hopefully, this never happened to you, but if it has, I want you to understand why. So let's say, because it happened to me a real long time ago. Let's say I went shopping at Macy's, okay? And I signed up for the store card, the Macy's card. And I went shopping, got some stuff, got a lot of stuff. And I didn't pay them. I didn't pay the card. So what happens? You get the phone calls, you get the notices in the mail, past due, blah, blah, blah. And you decide to file that in the circular, And eventually, you'll notice that you're getting letters from a collection agency. What happened here is that, in my case, that Macy's sold their uncollectible debt to a collection agency. And then the collection agency tries to go after the whole amount, you see? Call that factoring. And the company can also raise cash by borrowing money and pledging accounts receivable to secure the loan. That's what pledging receivables is. So why do companies do this? Because they need cash, right? So the first example is factoring. We debit cash, debit the factoring fee. Oftentimes there's a fee involved for the company, and we credit the account receivable. In the pledging receivables example, this is where a company's getting a loan from a bank and they secure receivables to get that loan. In other words, the bank can take the receivables if the company doesn't pay the bank back. So debit cash, credit accounts, notes payable. Okay, and one last thing before I let you go. Because we got to talk about at least a couple of ratios. You know this. One ratio that a company computes is called the accounts receivable turnover ratio. And it's good because it tells us how efficient we are at using our account receivable. Okay? It measures how often, on average, the account receivable is collected during the accounting period. All right? We take net sales divided by average account receivable. As I had mentioned before, the way that we calculate the average for things in accounting is we take the beginning balance plus the ending balance and we divide by 2. Okay, that's how you find the average. Beginning balance plus ending balance divided by 2. That's the average. So, yeah, that's accounts receivable turnover. And that, my friends, is the end of our discussion on receivables. And hopefully you've enjoyed that lecture on receivables. Now, just to remind you, Marlon, I see your hand up. Question, Marlon. Don't forget to unmute your mic. There you go.
It can
There
wait
you
till
are.
you're
I can hear you.
yeah, it can wait till after you're done with everything.
Okay, you sure? All right. All right, cool. So as a reminder, where are we? We're in week 9. So if you open up week 9, here's is what you need to do for this week related to our discussion we just had on receivables. And don't worry, I'll post the video as I always do. We have a discussion board. Okay. I know, oh, Dr. B, discussion board. You're used to it. We do this almost every other week. So here we have the discussion board. Open up the discussion board. A couple of your classmates. Thank you, Tim. Thank you, Jordan. Thank you, Jane, for already working in here. Nice. Okay, Jordan's got a lot going on here, and I love to see this kind of stuff. High level of detail. Tim, yeah, it's got to be a little longer than that. It's a nice try, Tim, but it's got to be way longer than a couple sentences, and that's not going to cut it. So, Tim, I'd love to see several paragraphs, kind of like what Jordan and Jane got going on. Unless you know what, that maybe no, yeah. So Tim,
No, okay, I got you. It's cool.
all right, I just want to make sure. I
Okay.
don't want to see your grade suffer for that. You know what I mean? So,
Right.
so okay, I'll look forward to your write up there.
Okay.
But yeah, just kind of like what you see with what Jordan and Jane had posted, and then Tim's got some good replies here, so that's good. And it looks like you replied to yourself. But that's cool. But yeah, that's so you're on the right track. So this is what I'm looking for in a discussion post, roughly 150 words at least, and then respond to 2 of your classmates. Yeah, around 100 words each, roughly, and that'll get you full credit if you do that. I'd love for you to have your original discussion post done by Thursday, and then respond to 2 of your classmates by Sunday. Yeah, so that way you have some time. And then, of course, the Chapter 9 quiz. Those are your action items for this week. Are there any comments, questions, or concerns about your work for this week? We're good. Y'all sure? All right. Okay. If you need anything, as always, you can email me, call me, or set up office hours. If you have any back work, make sure you get all that done, because from this point forward, we got to make sure that we're on time with our stuff, okay? So if you need anything, email me, call me, set up office hours. I'm always here for you. I sincerely appreciate all of you, especially for taking the time out of your day to join us today during the lecture. And again, I'm looking forward to another great half of the semester. So let's finish strong, okay? We got about 8 weeks left. We can get through this. I'm not worried about it. So let's stick together and make it happen. Thank you all so much. Appreciate all of you. Have a wonderful rest of your night. Take care. Bye-bye.